You know, every business tracks what it sells. That's the easy part. But what about the stuff that just disappears? Goods that walk out the door without a sale. We're talking free samples, accidents, you name it. It's a huge accounting puzzle. And in the next few minutes, we're going to solve it.
So, to get our heads around this, let's follow the story of a small business. We'll call it the Explainer Bakery. And like pretty much any shop out there, it's got this problem. Inventory vanishes from the shelves. And it's not because someone bought it.
And this right here is the million-dollar question. Because if you don't account for this the right way, you could get a totally skewed idea of how profitable your business actually is. It's a mystery that messes with your bottom line, and today we are absolutely going to crack this case.
All right, our first scenario is something we've all seen before. It's all about marketing. Businesses give away products all the time to get people in the door. Our bakery is no exception. Let's see how that looks on the books.
So, picture this. The bakery hands out 5,000 rupees worth of amazing cookies. Now, it might feel like you just lost a bunch of product, but from an accounting point of view, it's not a loss at all. It's actually an investment. It's a marketing expense.
So how do we record this? You can see the official entry right here. We debit what's called an advertisements account, and we credit the purchases account. This one simple entry is how we tell the correct financial story about what happened to those cookies.
And check this out. This has a brilliant twofold effect. First, it reduces your purchases, which makes sense. But second, and this is key, it correctly labels that 5,000 rupees as a cost of doing business, an advertising expense. It's not a loss on the goods you sold. It's a strategic cost.
Okay, let's move on to our next case. This one happens constantly in small businesses. The owner decides to take something home for themselves.
So the owner's got a family birthday coming up and grabs a cake. Simple enough, right? Well, in the world of accounting, that's not just a missing cake. It has a very specific name: drawings. It's basically the owner taking value out of the business for personal use. And here's how we track it. We debit a drawings account, and just like we saw with the free samples, we credit the purchases account. This little move correctly pulls the cost of that cake out of the business's day-to-day expenses. So what's the big picture here? Well, by crediting purchases, we make sure the business's cost of goods sold isn't artificially inflated by that cake. But even more important, that value is taken directly from the owner's capital on the balance sheet. This keeps everything clean and gives a true reflection of the owner's actual investment in the business. All right, let's switch gears to something a lot more serious. Free samples and owner drawings, those are planned. But what happens when you lose inventory completely out of the blue? I'm talking about an accident, a fire, a disaster. So let's imagine the worst. A small fire breaks out at our bakery, and a whole batch of expensive specialty flour is ruined. This is what accountants call an abnormal loss. And how you deal with it all comes down to one critical question. Was that inventory insured? And that one question sends us down two completely different roads. If you're insured, the accounting is a bit more complex. There are a few steps. But if you're not insured, well, the accounting is simpler, but the financial pain is a whole lot more direct. Let's start with the tougher situation. The bakery had zero insurance on that flour. The value of that entire batch is just gone. Poof. In this case, the accounting is, well, brutally direct. The entire loss gets moved straight into the profit and loss account. What does that mean? It means the full value of that flour becomes a direct hit against the bakery's net profit. There's no buffer. It's a straight-up loss. Okay, but let's rewind. What if the bakery owner was prepared? What if that specialty flour was fully insured against fire? Now what happens? Now, the process is totally different. You still record the loss, of course, but then you file a claim with your insurance company. And get this, that claim is now treated as an asset on your books. It's basically money that you're owed. But you know how it goes. What happens when the insurance check finally shows up? A lot of the time, it doesn't cover the full amount. So the money you do get goes into the bank. And the difference, the part you couldn't recover, that becomes your loss. It's still a hit to your profit and loss account, but it's a much, much smaller one than if you had no insurance at all. So we've looked at free samples, owner's drawings, even a disaster. After all these different journal entries and accounts, let's pull back and ask the big question. Why does any of this even matter? It matters because this is all about getting a true picture of your business's health.
Without these adjustments, the cost of those free cookies or the burned flour would just get mixed in with the cost of the goods you actually sold. And that makes your profit margins look way worse than they really are. By classifying everything properly, you see the real story. And this quote from our source material absolutely nails it. By separating out these unusual events from your normal costs, you can actually see how good your business is at its core mission. You get to see how profitable the bakery really is at, just baking and selling things.
So, the next time you look at a company's financial report, remember our little bakery and the case of the vanishing inventory. Because behind all those big numbers for sales and profit, there are all these other little stories of marketing, of accidents, of ownership, all carefully accounted for. And they give you the real picture. So what stories are you going to find?